You got the raise. Maybe you asked for it. Maybe your manager called you in, slid a number across the table, and you tried to stay professional while internally you were doing the math already. Maybe it came in an email with a lot of corporate language around it and you skimmed straight to the number. Either way, the number went up. Your salary increased. You earned it. So you did what every rational person does. You pulled out your phone, divided the raise by 12 months, and started mentally allocating that extra money. A little more to savings, finally making a dent in that credit card, maybe one actual upgrade to your life that you've been putting off. The math felt clean. The plan felt solid. You went to bed that night feeling like things were finally moving in the right direction. Then the first new paycheck hit your account, and the number was wrong. Not wrong like a mistake, wrong like it was just less, noticeably less than what you calculated. You stared at it. You checked the math again. You wondered if HR had made an error. You maybe even sent an awkward email asking someone to double check. They checked. There was no error. This is the moment nobody prepares you for. The raise was real. The excitement was real. But the paycheck told a completely different story. And nobody sat you down beforehand to explain why. That gap between the raise you got and the money you actually received, that's not bad luck. That's not a glitch. That is the tax system doing exactly what it was designed to do. And if you don't understand how it works, you will spend years getting raises that feel like they evaporate before you can do anything with them. My name is Lyra, and I pay close attention to the gap between what people think their money is doing and what it's actually doing. And this particular gap, the raise gap, is one of the most universal and least explained financial experiences out there. If you just got a raise and your paycheck confused you, this video is for you. If you're expecting a raise soon and you want to be ready, this is absolutely for you. And if you've ever looked at your salary and looked at your savings and thought, these two numbers don't make sense together, stay with me, because they're about to. If this ends up clearing something up for you, the subscribe button is right there. Now, let's get into it. Here's where it gets personal in a way that genuinely bothers people when they see it clearly. When Sarah got her raise, her employer quietly made a small adjustment to her benefits contribution structure. This is more common than most people realize, and it almost never gets mentioned in the raise conversation. At higher salary levels, some companies shift the employee's share of health insurance premiums slightly upward. It's usually framed as a standard benefits administration adjustment. What it actually means for Sarah is that her monthly health insurance contribution increased by $35. That's $420 per year coming out of the raise she just celebrated. Then there's the 401k situation. Sarah was already contributing 6% of her salary, which is a good habit, genuinely, but 6% of $74,000 is more than 6% of $68,000. Her contribution amount went up automatically with her salary, which means her take-home paycheck reflects that additional 401k deduction, even though the percentage didn't change. Now, this money is going to Sarah's future, so it's not lost, but it absolutely affects what she sees in her bank account each pay period, and she didn't factor it into her planning. That extra 401k deduction on the higher salary is pulling another $30 per month from her expected take-home. Back to the scoreboard. $6,000 raise. After all taxes and benefit adjustments, Sarah is realistically looking at about $270 to $290 more per month in actual take-home. She expected $500. The gap is real. It's significant, and not one person in the raise conversation mentioned it. But there's one more layer, and this is the one that quietly affects people for the entire year without them realizing it. When your salary changes, your employer recalculates how much tax to withhold from each paycheck. This calculation is based on your W-4 form, the one most people filled out on their first day of work and have never looked at again. If your W-4 isn't updated or optimized after a salary change, life event, or any major financial shift, your withholding can drift in one of two directions. Both are problems. The first direction is over-withholding.
This is where the government holds more of your money than your actual tax liability requires, all year long, and then returns it to you in April as a refund. Most people treat a tax refund like a bonus. It isn't. It is your own money coming back to you after sitting with the government for up to 12 months, earning you nothing. Sarah is being overwithheld by approximately $80 per month because her W-4 was filled out when she was in a completely different financial situation. That is $960 per year that belongs to her, sitting somewhere it isn't growing. The second direction is under withholding. This one is genuinely stressful. If your raise bumps your income in a way your withholding doesn't account for, you can end up owing money in April, often without any warning until you sit down to file. Sarah doesn't know which situation she's in right now. Most people don't. They find out in April, and by then the options are limited. This is the invisible leak in every salary increase. The raise happened, the tax mechanics shifted, but the W-4 was never updated to reflect the new reality. So money is either sitting idle with the IRS or building into a surprise bill. Let's stop talking about Sarah for a second. If you got a raise recently and your paycheck felt lower than you expected, now you know why. It wasn't a payroll error, it wasn't some bureaucratic mistake, it was federal tax brackets doing what they're designed to do. It was FICA taking its flat percentage before the conversation even started. It was benefit contributions quietly shifting. It was a W-4 that no one told you to update. An updated, properly completed W-4 aligns your withholding with your actual tax liability. No bloated refund in April that was always your money. No surprise bill that you weren't planning for. Just accurate withholding that keeps your money in your account during the year where it can actually do something. For Sarah, updating her W-4 returns roughly $80 per month to her take-home immediately without any other change. The second move is one that feels counterintuitive until you run the math. When your raise takes effect, increase your pre-tax 401k contribution at the same time. Every dollar you contribute to a traditional 401k reduces your taxable income by that same dollar. If Sarah increases her contribution by 2% when her raise takes effect, she reduces the amount of her new higher income that gets taxed at that marginal rate. The raise essentially funds the contribution. Her take-home increase is slightly smaller on paper, but her net worth is growing faster. Her tax bill is lower, and she's not feeling deprived because the adjustment happened simultaneously with the raise. She never experienced the higher take-home, so she doesn't miss it. The third move is one most people completely ignore, even when they qualify for it. If Sarah has a high-deductible health plan, she is eligible for a health savings account, an HSA. This account has a tax structure that exists nowhere else in the American financial system. Contributions go in pre-tax, reducing her taxable income now. The money grows inside the account completely tax-free, and withdrawals for qualified medical expenses come out tax-free. That is a triple tax advantage on the same dollars. Most people who qualify never open one. The ones they do treat it like a checking account instead of an investment vehicle. Used correctly, an HSA is one of the most powerful tools available for someone in Sarah's situation, and it directly offsets the raise interception problem. The fourth thing Sarah needs to understand, and this one changes how she evaluates every financial decision going forward, is the difference between her marginal tax rate and her effective tax rate. Her marginal rate is what she pays on the last dollar she earns, the rate at the top of her bracket. Her effective rate is the actual percentage of her total income that goes to federal taxes, when you average it all out, and it is almost always significantly lower than the marginal rate. People hear 22% bracket and think they're paying 22% on everything. They're not. Understanding this distinction changes how you think about raises, side income, overtime, and a dozen other financial decisions. Now, meet James. Same company as Sarah, same salary going in, same $6,000 raise coming out. Different outcome. The week his raise took effect, James spent about 20 minutes in his HR portal and another 10 minutes on a phone call. He updated his W-4 based on his current situation. He bumped his 401k contribution from 6% to 8%, letting the raise absorb the increase without him feeling it. He opened an HSA for the first time and set a small monthly contribution to start. James' immediate take-home increase looks smaller than Sarah's on paper. He's contributing more to his 401k, he's funding an HSA, but his taxable income dropped. His withholding is accurate. He will not be writing a check to the IRS in April. And in 12 months, James' actual net financial position, total wealth, not just take-home, will have improved by a meaningfully larger amount than Sarah's, from the exact same raise, the exact same tax system. One person understood how the interception worked and made 3 specific decisions. The other person waited for someone to explain it and is still waiting. Here is where you land after watching this video. You can do nothing. You can take the raise, be mildly confused by the paycheck, adjust to the new normal, and let the mechanics keep running on autopilot. You'll get your tax refund in April and feel briefly good about it, not realizing it was your money the whole time. 5 years from now, you'll have received raise after raise, each one partially intercepted before it reached you, and you'll have a vague sense that your income and your savings don't match, without quite understanding why. Or you can spend one deliberate afternoon on 3 specific things. Update your W-4, look at your 401k contribution percentage and decide if a small increase makes sense when the raise lands. Find out if you qualify for an HSA and open one if you do. That's it. That is the entire intervention. It doesn't require a financial advisor. It doesn't require an accounting degree. It requires the knowledge you now have from this video and a small block of focused time. The tax system is not going to explain itself to you. Your employer is not going to optimize your withholding on your behalf. Nobody is going to show up and make sure your raise actually reaches your savings intact. That part is yours to handle, and now you know exactly how to handle it. The raise was real. You earned it. Now, make sure you actually keep it. If this video changed how you think about your paycheck, there's a lot more where this came from. Next up, what happens to your raise after inflation gets done with it? Because taxes are the only thing working against you. That one is worth watching before your next raise hits. See you there.